For decades, Americans lived under an illusion so comfortable, so reassuring, that almost no one questioned it. We believed the economy was strong. We believed recessions were temporary. We believed that the worst financial disasters were behind us and that the systems protecting our money could never fail again. But as experts look toward 2025, many of them are quietly sounding alarms. Not publicly, not in front of cameras, but behind closed doors, in private briefings, and in hushed conversations among economists, analysts, and policymakers. They warn that the economy is approaching something deeper than a slowdown, something more dangerous than a typical recession, something many are calling a reset. And the most unsettling part, the warning signs have been building for years, hidden in plain sight, while politicians reassure the public that everything is fine. To understand how we reached this moment, you have to go back, not months, not years, but decades, to the origins of America's modern financial system. This story begins in the early 1970s when the United States abandoned the gold standard. Overnight, the nature of money changed. Before this shift, money represented something tangible, gold in vaults, reserves that backed every dollar printed. But after the change, money became something very different. A concept, a digital entry, something banks could create through lending. Every mortgage, every car loan, every business credit line became a form of newly created money. The economy didn't just operate on debt, it grew because of debt. Banks became engines of constant credit creation, and the system began relying on one fragile ingredient, trust, because the moment people stop trusting banks, the entire system collapses. The first major sign of weakness in this new system appeared in 2008. The housing bubble burst, banks failed, and global markets almost collapsed. The Federal Reserve stepped in with massive interventions, near-zero interest rates, emergency liquidity, and trillions in quantitative easing. The strategy worked, at least on the surface. The financial system stabilized, but the long-term cost was hidden. The rescue taught banks and corporations a dangerous lesson. Take as many risks as you want because the government will save you. This mindset shaped the decade that followed. Borrowing exploded. Companies over real estate soared, startups burned through billions, and the entire economy became addicted to cheap money. From 2010 to 2020, ultra-low interest rates fueled one of the longest growth cycles in history. Tech companies ballooned, asset prices skyrocketed, consumers borrowed more than ever, but underneath all the optimism, cracks began to form. Those cracks widened dramatically during the pandemic. Trillions of dollars were injected into the economy. Supply chains broke down, and inflation surged to levels not seen in 40 years. The Federal Reserve reacted with the fastest interest rate hikes in modern history. And this is where the next crisis quietly began. Higher interest rates didn't just make loans more expensive. They began destroying massive amounts of wealth that had been built during the era of cheap money. Banks holding long-term bonds saw their portfolios lose value. Businesses lost access to low-cost credit. Consumers struggled with rising debt payments. Home buyers were priced out of the market, and corporations refinanced old cheap debt at new expensive rates. These weren't isolated problems, they were systemic. The fabric of the economy began to tighten. The situation worsened as banks started losing deposits. Savers moved their money from checking accounts to high-yield platforms and government bonds. Tech companies and startups already hurting from reduced venture capital pulled billions from regional banks just to stay alive. This dynamic contributed to the collapse of Silicon Valley Bank in 2023. But that was just the first fracture. Why at the end of 2024, more institutions quietly showed stress, shrinking deposits, rising loan defaults, declining asset values, and tighter credit standards. It didn't look like 2008. It looked slower, quieter, and more dangerous, like the system was suffocating from within. By late 2024, global regulators introduced new liquidity rules that forced banks to reveal vulnerabilities most had tried to hide. Suddenly, those unrealized losses on bonds became unavoidable. Balance sheets weakened, banks tightened lending, businesses struggled to borrow, and without credit, the economy began slowing not through a dramatic crash, but through a slow erosion of financial oxygen. That erosion is what experts point to when they warn of a 2025 reset. It's not a single event. It's a chain reaction. The fallout becomes visible not through headlines of collapsing institutions, but through the quiet tightening that affects everyday people. Businesses delay expansion, startups shut down, consumers face harsher loan requirements. Mortgage approvals slow, credit limits shrink, construction projects pause, and unemployment begins to rise slowly at first, then faster. The economy doesn't break overnight. It deteriorates gradually, like a building with unseen cracks spreading through its foundation. Meanwhile, the government tries everything to keep the system alive. Emergency liquidity programs, quiet regulatory relaxations, forced bank mergers, and reassuring public statements. Officials claim the system is stable, but behind the scenes, they have private briefings about liquidity, stress, insufficient reserves, and the increasing risk of a major tightening event in 2025. Corporations respond by increasing cash holdings, hedge funds limit withdrawals, and global investors quietly reposition their portfolios. These are not the actions of people who believe everything is fine. When you zoom out, every major event leading to 2025 fits a historical pattern. In 1929, credit dried up before the market collapse. In 2008, toxic assets were hidden until they triggered panic. Every financial crisis in the past 50 years followed a period of rapid rate hikes, just like the ones we've seen recently. And every major transition in financial history coincided with the technological shift from ATMs to online banking to mobile apps. Today's shift is digital currency. Governments worldwide are preparing new systems. In the US, that preparation takes the form of the emerging digital dollar framework. This isn't conspiracy, it's public policy. Programmable money, instant transactions, centralized oversight, automated taxation, potential spending controls, expiring stimulus. When the current debt-based system reaches its breaking point, the next system will be ready to replace it. And many experts believe the 2025 recession may be the event that accelerates that transformation. As the year approaches, analysts warn that the economy is heading toward a turning point. More banks may merge quietly. Credit may tighten further. Defaults may rise. And the transition to digital currency may be presented as a solution to the instability, not as a replacement, but as an optional parallel system. The real shift will happen gradually, not through a dramatic announcement, but through small changes that add up over time, until the old system fades and the new system becomes unavoidable. The deeper truth is that the financial system is far more fragile than most people realize. Crises no longer happen in explosive cinematic collapses. They creep silently. Debt-based economies eventually reach limits, and when interest costs exceed revenue, structural changes become unavoidable. And the shift toward digital money, whether people want it or not, is already underway across the world. We are entering a new financial era, one that will reshape savings, investments, lending, and economic power. Some people will ignore the signs and get caught off guard. Some will lose everything because they assumed the system would always work the way it always has. But others, those who understand the patterns, will adapt early, protect themselves, and position themselves for the opportunities that always emerge during major transitions. What's coming in 2025 is not the end of the system. It is the end of a chapter and the beginning of another. If you want to stay prepared as this story unfolds, make sure to subscribe, because in the next video, we break down exactly what this shift means for your savings, your freedom, and your future.